Hello, everyone. Welcome to our webinar. My name is Jim Langston. I'm the Commercial Vice President here at RFI Global, and I'm based in the New York City area. Luke Alchin, our Director of Research, is based in London, and he will be our presenter today. And we're both absolutely thrilled to have you join us. And thanks for taking time out of your busy schedules to be here. I know it's really difficult in these times, but I think you'll be happy you did. So today we'll be discussing consumer trends shaping the financial services industry in 2025. It's an output from our recently released MacroMonitor data set. And this is a subject, as you all know, is incredibly important and timely in these volatile and uncertain times. Um, a little about RFI Global and MacroMonitor first. RFI Global is the only global data solutions provider that focuses exclusively in the financial services industry, be it banking, investments, insurance, payments, lending. We are the only ones that focus in that space. It gives us a unique advantage. Excuse me, folks. The allergy season here in the Northeast and a little gravelly today. And MacroMonitor. Is the deepest and most comprehensive data set of the U.S. consumer market and their financial behaviors and attitudes. And it's fueled by a survey of 5,000 households in the U.S., and this has been done for over 40 years, thereby delivering meaningful analytics and truly unparalleled trend data. There's no other survey or data set out there that goes back that far that looks at this market. Our goal today is to provide you with valuable insights and practical takeaways that hopefully you can apply in your respective roles and give you that competitive edge in understanding your clients' behaviors and attitudes in their financial decision making. Yet, just to rest assured, this is just merely the tip of the iceberg of the data and analysis. We're going to show you what the data set is showing us from a top line approach, but an output, but it goes way deeper than that. That really helps you to do really deep and unique analytics and strategic planning. Before we get started, a couple housekeeping things. We're recording the webinar and we'll share it with you afterwards. And then feel free to use the Q&A feature to introduce yourselves and ask appropriate questions that we'll answer upon the completion of the presentation. And without further ado, let's get started. Over to you, Luke.
Excellent. Well, thanks, Jim. And welcome everyone to join us today. In this webinar, we'll be discussing the evolving consumer financial landscape, how switching rates are soaring, how the demand for financial advice is at the highest rate it's been for nearly a decade, and why we're at a pivotal moment for digital, namely mobile banking and mobile investing. To start, I think let's talk about the current landscape here. The consumer financial landscape is evolving. Households are facing a number of challenges and are more stressed. But that being said, there is still confidence in the market. The confidence remains. The tagline is "Wealth is up," but looking a little bit deeper uncovers a more interesting dynamic in the market. We see in the data that households are split between prioritizing debt repayments and building financial wealth. And as such, the wealth divide in the US is actually in fact growing, with 17% of households now controlling 88% of these liquid or of these investable assets. So while some households are selling their liquid assets to either pay down debt or to fund their lifestyle, what we're seeing is that high asset, high income households are in fact moving these funds into other asset classes and reducing the liquidity of their assets, which is a display of confidence in the current market. But as mentioned on the previous slide, there is a divide growing, and there is a divide between prioritizing debt repayments and then building financial wealth. And I think that this chart here perfectly encapsulates this fact. What it is showing is that there's an increase not only in the number of debt-free households, but also the number of asset-free households. In fact, the growth rate we're seeing of these asset-free households actually is exceeding the debt-free households, which is suggesting that some of these households remain in debt despite selling their assets, which I think is a worrying thought. So there are growing concerns among households in the US, and more of these households are feeling disorganized with their finances compared to what we saw previously. Many are now seeking low-cost alternatives to the current financial services. And in response to the challenges facing the majority of households, we are seeing a greater number of consumers not only shopping around for their financial products, but there is also a growing openness to try new financial products, new services, new providers, and new platforms. As a bit of a side note as well, we have seen a significant increase in the number of consumers using buy now, pay later to fund everyday household purchases, with more than 1 in 4 having now used buy now, pay later. And I think this too highlights just some of the financial struggles facing many of these households in the US currently. In parallel to that as well, we see households have become more cautious and become more risk adverse as well. The appetite for investment risk among US households on average is mirroring what we saw following the 2008 global financial crisis. And I think this shift is something that will be felt by financial institutions, by investment companies over the years to follow. So as mentioned a moment ago, consumers are shopping around more than what they have previously. And while cost considerations are a factor, it's not the only driver behind the soaring switching rates that we are beginning to see. So just to sort of summarize it as well, to highlight this, we're seeing around 27% of households currently thinking about switching their primary investment company. And so this is more than at any point in the last decade. And so this trend itself is being fueled by the younger investors. So you can see on the right there, it's really the Gen Zs and millennials are significantly more likely to be or to have intentions to switch, and they're the ones who are really driving this behaviour. And when I think about switching, there are 3 key themes that seem to come through. The intentions to switch investment providers is namely driven by the demand for simplicity, simple, better tools, and smarter and more supportive financial solutions. And I strongly believe that these factors are closely linked to one another. Cost considerations are not only driving consumers to shop around, but it's also led them to be greater self-serving. And this in turn is fueling self-confidence and an affinity towards digital tools. At the same time, consumers seek to simplify their financial management because they have taken a more leading role in managing their finances. And this is why we're seeing a higher rate of consideration for relationship consolidation. And consolidation poses a serious risk or threat to client attrition, especially for the investment providers who are failing to evolve with the consumer expectations. As mentioned, these expectations are for simplicity, better tools, and smarter, more supportive financial solutions. And while consumers as a whole are taking a more active role in managing their finances and investments, there is still a need in the market for financial advice, and this need, in fact, is growing. So in the data, we see that 64% of households are seeking advice before making major financial decisions. And this is the highest we've seen in nearly a decade. I think what's also important as well is the fact that there has been a spike in this activity more recently. So between 2022 and the end of 2024, we've seen a sudden spike in that activity as well. And not only are more households seeking financial advice, they're also in fact seeking advice on a broader range of topics. And I think this reflects the growing challenges that are facing the average households in the US currently. Stuff like retirement and investment planning have both increased significantly and remain primary areas that households are seeking advice on. But that being said, the greatest increases that we've seen in terms of financial advice are for tax planning and debt consolidation planning. And now you might be wondering how this shift is impacting consumers' decisions when they're choosing a financial professional for their advisory needs. And it might not come as a surprise when I say households have become more cost conscious, cost consideration has risen, but so too has expectations around proactive communication or proactive communications. Compared to 2022, there's a significantly greater proportion of households expect their financial professionals to communicate proactively. And in the face of adversity, consumers, I think, want to feel understood, and they want their advisor to demonstrate this by being proactive. Confidence goes hand in hand with expert guidance. It's a new trend we've seen. It's very much been a case for many, many years now. But what this means is meaningful engagement at the outset is key to long-term loyalty and continued interaction. The effect of that first interaction is echoed in all future engagements. And the reason why this is especially important is on the next slide. So looking at the investment behavior of households, we see it's the 18 to 29-year-old segment is the only age cohort in the market where we've seen a consistent and continued growth in investment activity. Households are entering the investment space earlier than ever before, which makes a strong digital offering essential to attract and retain this growing segment. But as mentioned on the slide before, meaningful first interactions are key to long-term loyalty and continued interaction between these young investors and their advisors. So there are more young people looking to invest for the first time. You've got to make sure that when you're engaging with them in its very first instances, that it's a positive interaction, and that will fuel their continued use and reliance on the advice they receive, and also help foster confidence, which in turn will cause them to return. Which I think is a perfect segue into the fourth and final section in today's webinar, which is digital, and how mobile is leading that digital shift within finance in the US. For a long time now, digital banking has been present in the day-to-day lives of the majority of US households. But the way in which consumers are interacting with their banks digitally has gradually shifted in favour of mobile banking apps. In fact, 2020 marked the point in time when mobile apps became the #1 channel for digital interaction. Incumbent banks realised this, and it led them to invest greatly in innovation and delivering meaningful enhancements to their digital banking platforms. And now I think it's the time for investment companies to do the same. While lagging a little bit behind banking, the shift, or the consumer shift towards digital and mobile, is just as evident in the investment space. While desktop remains the preferred digital channel for online investing, if this trend continues, we expect to see mobile appearing ahead of desktop and being the #1 channel for investment interaction or investment management early into 2026. And I think all this has been possible due to this decrease in reliance on in-person engagements. It's really paved the way for digital platforms to become that preferred channel when it comes to banking and investing. And again, it's also that this shift is, this shift in preference, I think, has allowed for fintechs to establish a strong foothold in the market. As mentioned earlier in the webinar, I said how switching between providers have become more common, and as this will put significant pressure on providers that are slow to innovate in a rapidly changing market. While the US market has been a little bit slow in terms of warming up to fintech compared to Asia and Europe, fintechs have since established a strong foothold in the investment space in the US. I think from a directional perspective, fintechs are rapidly gaining ground on their competition, on their competitors. We're seeing around 1 in 5 primary investment relationships established in the last 24 months. It has been with a fintech provider. I think this highlights not only like a growing comfort for digital-only providers, but it also reflects the point I made earlier at the start of this webinar that there appears to be a growing openness among consumers to try new financial products, new services, new providers, and new platforms. I think furthermore, these fintech users are not only more likely to shop around when seeking new financial products or services, they're also the ones who are more likely to consider eliminating some of their relationships with financial institutions in order to simplify their finances, which should be a worrying thought given the fact that 1 in 5 households have used a fintech provider for their investment needs, and also the fact that 1 in 5 households who have started or opened just a new investment relationship in the last 2 years has been with a fintech provider. So now I've spoken about digital innovation, fintech, and consumers' comfort in using new digital services. I also spoke about the growing need for advice, simplification, better tools, and smarter, more supportive financial solutions. Which begs the question, where will AI and robo-advisors sit in this evolving consumer financial landscape? Although trust in robo-advisors still remains relatively low, we see that many consumers are uncertain rather than dismissive of robo-advisors and robo-advice. I think in short, I would say robo-advisors will sit beside traditional advisory services. When delivered effectively, hybrid advisory models can help deliver a more personalised service to consumers, which in turn can foster greater trust. And in a time of unprecedented financial challenges, personalisation has never been more critical than it is now. But what does this all mean for financial institutions? What are the key takeaways and what are those call to actions? And in short, I think I can summarise it in these 7 points here. Households are increasingly looking to simplify their financial management and prompting many to consolidate their assets and relationships. This trend will put investment providers at more risk or greater risk of client attrition, especially if they fail to evolve with the consumer's expectations. Switching between providers has become more common, with households now more open than ever to exploring new products, new services, new platforms, new providers. And this creates significant pressure on providers that are slow to innovate in what is a rapidly changing market. Young households are entering the investment space earlier, which means making a strong digital offering essential in order to attract and retain this growing segment. But at the same time, households have become more risk averse, and as such, tools that could help individuals assess investment risk would likely be well welcomed, offering reassurance and helping build investor confidence. As mentioned on the slide before, hybrid advisor models, blending traditional advice with robo-advisory services, I think could strike the right balance between personalised service and scalable efficiency. When delivered effectively, these models can help foster greater trust among clients. There is a rise in demand for comprehensive financial advice, with households seeking guidance on a broader range of topics than ever before. Although there is expectations for proactive, personalised communication. This is increasing as clients face unique challenges. They want to feel like they're being understood by their advisors and by the financial professionals that they are approaching. And finally, delivering value early in an advisory relationship is going to be key. Meaningful engagement at the outset can fuel that long-term loyalty and long-term and continued interaction. Coming back to what I said about the young household and those young investors, this is a key growth segment in the market. These are the ones who will be likely to be approaching these advisory services for the very first time. And in terms of what they receive in that interaction will underpin their usage and continued usage in the years to follow. I think in short, it sort of boils down to this simply. Households are more stressed but remain confident in the market. Those who fail to evolve with consumer expectations risk client attrition. Younger investors represent a key growth segment in the market, and I think personalisation has never been more crucial than it is right now. But yeah, that's it in terms of what the data is showing us at the webinar. But I say, as Jim mentioned at the start of the session, the data and the insights that we shared today really is just the tip of the iceberg. This is some key highlights from our comprehensive data set. MacroMonitor offers an abundance of insights on the behaviours and the intentions and the preferences of US households. So please feel free to reach out at any point if you have any questions or would like to learn more about the US consumer financial landscape, or more about the MacroMonitor study. I'm going to stop talking now. I'm going to hand back over to Jim. I know there's been a couple of questions that have been asked in the Q&A section of the session. So yeah, I think now's the time to answer some of those questions.